Welcome back to Blue Collar Retirement and part two of our series on investing in retirement. Let's start with a question. If the market dropped tomorrow, would you feel comfortable staying invested or would you feel pressure to make a change? That question matters more in retirement than at any other time in your life because now it's not just about growth. It's about protecting income while making sure your savings last. An important decision to make as you enter retirement is how much risk you are still willing to take with your retirement accounts. There's a very simple formula called the rule of 100. Here's how it works. Start with the number 100. Now subtract your age. The final number is the percentage of your retirement funds that should be in risky assets. For example, you just turned 65 and retired. With the rule of 100, you subtracted 65 from 100, and the result is 35. 35% is the amount of your retirement savings that could be in risky funds. Risk is a subjective issue. I had a client that if she did not have $100,000 in the bank, she couldn't sleep at night. Another client wants to buy cryptocurrencies, which are a very volatile class of assets. We remember times like 2008 to 2009. When retirement accounts got cut in half. You had time to recover, but can you tolerate that type of scenario in retirement? So in retirement, your savings need to have a growth rate better than what the average checking account will offer. Retirement can last decades, and during that time, inflation continues to rise. Over the last 10 years, inflation has risen 38%. The grocery bill that cost $100 in 2016 now costs $138. You may be blessed to live 25 to 35 years in retirement and need to consider this issue in your retirement plan. In our last episode, we looked at a topic of interest-bearing investments. We looked at a wide variety of investments with different lengths of maturity to help position assets with minimal risk. Another option is the stock market. The stock market has historically been one of the primary ways to generate long-term growth that helps to keep up with those price increases. Without some exposure to growth, savings can slowly lose value over time. Stocks represent ownership in companies. When those companies grow, your investments can grow with them. In retirement, stocks are typically used for long-term growth, inflation protection, and helping ensure your money lasts. But they also come with volatility. Prices move up and down, and sometimes quickly, which makes them more complex to manage in retirement. During your working years, downturns can be uncomfortable, but you're still contributing. The idea of cost averaging was at work. When the market went down, you were able to buy more of your investment. And when it moved up, you bought less. Over time, you averaged your cost of those investments. In retirement, you've stopped adding to your accounts and you begin to make withdrawals. Taking money out during a downturn can have a lasting impact on how long your savings last. This is often called sequence of returns risk, and it's one of the most important risks to understand in retirement investing. The goal isn't to avoid risk completely, it's how to use it appropriately. This usually means balancing stocks with more stable investments. Some portion of a portfolio is used for growth, while another portion is designed for income and stability. This balance helps reduce the impact of market swings while still allowing for long-term growth. There are a variety of ways that a person can invest in the stock market. Traditionally, people would use a brokerage firm to buy the stocks and mutual funds that they wanted in their portfolio. Today, there are firms that allow you to manage your own stock picks all by yourself. Many firms allow no-cost trading. I recently found an old brokerage account receipt. It showed that when I bought 200 shares of a stock, I paid a fee of $200. Now I can buy 2,000 shares and have no fee to do it. Today, you can buy a stock, mutual fund, or ETF with no fees. Because of the wide variety of choices, people still use a brokerage firm to advise them and complete the transactions on their behalf. This type of help normally comes with a fee structure. One of the biggest challenges isn't the market itself, it's how people react to it. When markets rise, it's easy to stay invested. When they fall, it becomes harder. Making decisions based on short-term movements can disrupt long-term plans. That's why having a clear strategy matters. It helps guide decisions and keeps you consistent. Let's define some terms. You can buy individual stocks of publicly traded companies. For example, you can buy shares of a stock like Apple Computer, and the value will rise and fall based on how the company performs. It is significantly easier to obtain information about individual companies with the help of the internet. The challenge is how much time and energy a person wants to put into researching and selecting a group of stocks. You can also buy a basket of stocks by investing in mutual funds or exchange traded funds, known as ETFs. The idea of mutual funds have been around for a long time, but became more popular starting in 1924. Mutual funds build a basket of stocks around a specific goal or concept. For example, you can buy a mutual fund that concentrates on energy stocks or pharmaceutical companies. You can also buy mutual funds that are a variety of bonds. Mutual funds give you a diversity by buying many companies to help compensate for the ups and downs of any one individual company. Exchange traded funds, or ETFs, are also a basket of stocks. ETFs became available in the early 1990s. Though they are also a basket of stocks, they have some important differences. Mutual funds are actively managed and have a set of fees called the expense ratio. All mutual funds settle at the end of the trading day. For example, if you buy a mutual fund in the morning and want to sell it later, you will have to wait until the market closes to learn what your sell price was. ETFs are more liquid because they can be bought and sold throughout the day. A popular way of using ETFs is using them to invest in the major indexes. So, for example, you can invest in the S&P 500 index by purchasing the ETF SPY. In either case, you should ask for a prospectus. A prospectus is a required document that discloses all of the important information about the mutual funds and the ETFs. Not all stocks behave the same way. Different industries and sectors perform differently, depending on economic conditions. Diversification spreads investments across different areas, helping reduce the impact of any one investment performing poorly. In retirement, this can help smooth out returns and reduce overall risk. Some people believe the stock market is too risky for retirement, while others believe it's the only way to grow money. The truth is somewhere in between. The stock market is a tool. Used alone, it can be volatile. Used properly within a balanced plan, it can support long-term stability. In summary, you need to start by determining your tolerance for taking risk as you transition into retirement. It becomes less about aggressive growth and more about supporting income, keeping up with inflation, and helping your savings last. The key is balance and understanding how it fits into your overall plan. In the next part of this series, we'll bring everything together and talk about withdrawing funds and turning savings into income.
Safety first, retirement, ensuring your financial dreams.